Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you.
Hi and welcome to the podcast. I'm David Lockton. Today we're talking about really balancing risk and your tax in your investment strategy going forward. And I'm joined by my co-host, Cole Eccles. How are you, Cole?
Good, thank you.
That's good. Really one of the, I think in Australia, I think a lot of people take extra risk or in that high bracket when they are in that sort of desperation scenario at times and so forth. What have you seen people invest in the high risk stakes?
I think one of the ones is that's very common at the moment is obviously crypto. And like you said, there are people looking for a quick win. And we've seen that. And we've seen the total opposite as well. So it's something that could go from, and I've got people that have made lots of money in a very short period of time and almost lost all of it overnight, literally overnight. You wake up in the morning, it's almost nearly gone. So we always say to people, if there's this promise of this really big returns, then you must accept that there's also the potential of massive losses as well. There's no free lunch.
Yeah, that's one of them. And I think a lot of people going into crypto and that, and like we don't provide advice on crypto, by the way, but I've got a fair few clients that actually have some crypto, and just the fluctuation from year to year, what I've seen is just craziness. There's definitely something I would stay away from. But so that's one of the ones. And generally, a lot of people actually, whether they know it or not, most people have home loans and so forth. They're borrowing to go into that scenario, whether they like it or not. What else is there that people can get into high risk?
With shares and that, it's a lot of out there. Like I've known someone that's his whole strategy is to invest in really out there stocks because he feels that he's running out of time, and this is the only way to get ahead is to take these really big, and I can almost call them gambles almost, as investing in these high risk companies that are not really well known, but they're promising a lot of it in the tech space, and those types of things again as well. And it always go back to, I think we spoke before about Warren Buffett saying that he only invests in stuff that if that's the only one he held, he'd hold it for the rest of his life type of thing.
And understand it.
I
think I've got a few clients with they tell me they've got the hot tips and they pick out a share, and all I can see is it's been horrible for a long time, but they know better. Some of those things, going into the share market looking for the next winner, if it's your only share or something like that, can be hugely dangerous. What else is out there?
And then I don't think you can, I suppose by law, advisors can't recommend it, but people they're just borrowing money to use that to secure more lending to go and invest in something. So that's obviously you losing the potential to lose not just your money, none of it's your money really, he's losing someone else's money and you need to pay that back.
Like over time, borrowing money to invest in the share market investments. So back in the day when they had the market crash in 87, not 87, when was the GFC? What year was that? 2008, 2009. That wiped out a lot of people, and that wiped out the borrowing to invest really in the share market from advisors, scenarios and investments, and also borrowing money to invest in property can have problems as well. When if anything's got to be sold in the short term, that's when that risk really goes up. Because generally, if you buy, whether it's property, whether it's shares, if you're buying well over a long period of time and you're understanding what's going on, they both have potentials, but they also have potential downside. And I think from dealing with being a financial planner over 10 years now, I feel there's so many people that really are not in the high risk bracket. But you can actually look at their investments and go, oh my God, they're in the high risk environment, whether they know it or not. And I just really feel that even with a lot of scams out there, I must admit I got bloody scammed myself the other week, and I just don't know how. I didn't actually lose any money from it, but I clicked on the button and just thought it was a thing, and it was like, oh my God, I called up the bank straight away. It's very easy. They're so good these days. But that was just like a payment for a postage thing for a few cents, and all of a sudden there's thousands of dollars they're trying to get off my credit cards. It's what the hell happened there? All that stuff, and there is people out there you see on the news all the time. Whenever you've got to really give up control to your money to out of your environment, out of your control, obviously there's some problems in that. So really understanding, I think for balancing a lot of people's own risk profile, I think a lot of people wouldn't know what it is, because it's a little bit like blinker strategy when you go into something like you think and you hope and you pray that is going to work. You don't actually consider what if that didn't work? And what if I lost all that money? And if I borrowed all that money and it goes the wrong way, what happens? I've had people come to me many times, say, I want to borrow $1 million and stick it into the share market. And I'm like, have you ever done that before? What's your experience in the share market? It comes to property transactions where not the normal sort of buy and hold scenario where people go into developments and so forth, where it has great potential for reward, but also has a lot of potential for problems and can be very costly as well. So I think a lot of people just need to understand what their tolerance to risk is before they go out there with the blinkers on.
And like we said just class before, it's even when you're going through what their investment risk tolerance may be, it's sometimes they can be quite bullish, but when you talk to them, you think, I don't really think that. And then it's almost like if you've never really invested in the share market, if you've never experienced a downturn, you may react differently to what the question says and what you're saying now, and what actually happens in reality, how you may then react. So it's important people understand how they, because like I think we said before, I think what's the saying, that you feel the losses twice as much as you feel the gains. So
with it, I think with the most recent sort of major scary downturn was the coronavirus, and the market dropped sort of 30-odd%.
Yeah.
Really, it was like within a few days, within a month, and then it really popped back. But that was bloody scary. And if you've got $1 million borrowed in that environment, and depending on how you borrowed, you could have margin calls or calling in debt and or panic.
Yeah.
Obviously, there can be big problems. And so really keeping your exit strategy and being tax aware, and also I think understanding your risk profile is very important in this consideration. And then you've got really smart tax structuring around that. What's the 4 common areas we've got in that?
One, I suppose the most simplest one is splitting income between partners or spouses with varying tax rates. If you're going to investment where there's income tax, I suppose that's going to come from that investment, is invested in maybe invest the money in the lower earning spouse's name, but then obviously you can consider down the track when that investment gets sold, how the capital gains taxes and that, but that's probably a common one.
It's funny how many people, like who is the dominant one who earns the money, that hasn't taken the consequences of the earnings and also the capital gain problems if you've got a lower spouse. So I think what you're touching on there is a very valid point, like actually get some advice or understand the consequences before you actually buy anything.
If you Google, it'll say, I suppose if you haven't really Googled it, but if you feel it would say that's a way to do it.
Google doesn't know everything, right?
Is to put the income in the low income spouse's name, partner's name, but then it doesn't take a factor in anything else. Everything has always got to be thought out. So splitting that, and then there's things like trusts, which I suppose is a bit more involved than that, but then that allows you to distribute income to kids, I suppose. Obviously, there's limitations. Again, you need advice around that. Limitations around there. Investment bonds, I think we touched on previously. Again, that's more for high income earners. And then obviously putting money through super, you get obviously taxed at a lower rate, but you forego access to your funds.
Yeah, and then probably the last one is the company structure for businesses owned out there. They can keep and invest money from pre-tax money, a lot of them, depending on their scenario. And that the trust one's a really good one for a lot of people with already tax paid money, so money they have ready to invest and so forth. So there's all really tricks in each one of those. Like the super contributions is always a great long-term wealth strategy, but if you're in your 30s, it's bloody a long way away. And if you don't need the money for a long term, you feel like you're going to work for a long time, then that takes into account what type of vehicle may be effective, and then one spouse might be off for a while, but then they may go back to work. Or there's so many different range of things that actually can happen from being smart around the tax. It actually can get really complex. Which is really the wealthy, they don't avoid the tax and the tricks. They really use structures to their advantage. And just knowing where you are. But I think the spouse one you originally mentioned is really valid for so many people. The trust ones is when it gets a bit more complicated. And then if you've got business owners structuring and how the money gets through to bucket companies or holding companies, or there's a variety of different ways that can happen there. It really gets complex. I know myself when I'm looking at different things, it's like a lot of the time you'll put your head in the sand because it gets too hard. And that's where most people need some help, and just understanding if they're buying some shares or they're buying investment property, and then depending on what else they potentially are buying.
And another one I just thought about as we don't suppose is people closer to retirement with an age gap, or quite a significant age gap. So this one's going to have access to super before. There's potential to put money into a really tax effective environment and have someone access it if there's 4 or 5 ways. But again, it's all comes back to is planning, because and trying to factor in what may happen down the track, because you could make decisions now that, like you said, super through. Oh yeah, it's only 15% tax. You don't have access to money for the next 30 years, and now it's locked away. Yeah,
It's actually getting the whole variety. And what you were touching on then, so if you're a little bit older and you're doing planning for retirement, entitlements down the track to age pensions and things, depending on where the money is in superannuations, and age differences between spouses, what you thought you mightn't be entitled to, you might be if you actually structure and get some help around that. That's where it gets ultra complicated depending on what you've actually got. Yeah. And one of the other ones that comes into a lot of this is the behavioural risks of people. And what I find with people's behaviour, how they react to certain scenarios, when they haven't got someone to call or they don't have an advisor, what mistakes could they make?
Well, the big one is obviously making, like you just mentioned about coronavirus. So the worst thing someone could have done back then was, if it was solid investments, to sell out of it as soon as it dropped to 30%. And then, because that's always the issue, I think we've touched on the previous episode with like understanding your risk and time in the market, and that is to sell with coronavirus, because there's so much uncertainty. The whole world was coming to an end. You didn't know how long this was going to last, if it would ever recover. So if you sold out and then there was a recovery, and is that just the old dead cat bounce, and then you're waiting, before you know it, you're buying in a lot higher than what you sold out, and that's it.
Yeah, the behavioural thing, like I don't know how many times, we've got a lot of clients, but very few actually call just over that have been through the cycle. So their understanding of what happens, and also probably their understanding of my response to it as well. It's like generally it's more of an opportunity to buy more, not sell anything.
Yeah.
But if you haven't got that support and help, that's when you can make the biggest and most critical mistakes of selling out at the wrong time, locking in potentially some losses, putting the money under your mattress and missing out on the recovery, which in coronavirus happened incredibly fast. If you look back at 2008, 2009, the market went down for 2 years, and about very similar amounts for 2 years. So that was quite painful. But that was different. That was more of a recession we were going into. Coronavirus was just
short period.
It was a short period. It was what it was. Unbelievable it didn't do more damage in how fast the market recovered. And then just most recently, when Trump's tariffs, that spooked the market for about 2 weeks. So it was pretty short-lived. But that's fully recovered right now, and who knows what's going to happen over the things. So making mistakes through those periods, and that just becomes down to behavior. Once you put actually under pressure, how are you going to handle that? So it's just actually understanding that, and that comes to anything. One of the big things we probably haven't seen in Australia is really a big downturn in property and so forth and those. So people are pretty comfortable with things going up, where it was amazing how property went up through the coronavirus period. It was just crazy. No one expected that to happen. It just did. But you don't know what's around the corner. But one thing you better be really careful how you're going into any long-term investment is how you're going to behave in that period of time, because I think it can be one of the biggest risks you have out there. So what about also then you've got market risk, haven't you, as well?
There's always market risk. There's the market moves in cycles. But just to go to the point before, is that behavior, and it's also, again, understanding if you're going to put money into share market investment, is that time frame. So understanding if you put money into the market just before coronavirus hit, and the intention was, you're going to put it on a highest deposit in 12 months' time, and suddenly it fell, then obviously you would react that way. But if you understanding that investment is a long-term investment, 7, 10, 15 years, that should give you some comfort as well, that you don't need that money right now, so you could write it out, but then it still comes back to how you react in that. So it's all about, again, understanding investment risk, understanding your time frame, because when you go into invest in anything that's linked to market, that could be property, shares, whatever, there's the risk that in the short term, that investment value may fluctuate. But over the long term, if it's a sound investment, it's going to appreciate in value over time.
I always find it's not it's going to, especially the share market, it moves around a lot. But also just property, like if you tried to sell your property at different times, you know yourself when the market's peaked and then it comes off. It always does. And it's very hard to sell anything right at the peak, because it's an unknown. You know, give it another 3 months, I should have held that, or I should have sold that, or whatever. It happens to me all the time. A client will say, oh, Dave, I'm going to do this and do that. Is it a good time to sell or buy? It's like, how do you know? Do you know what I mean? Because you don't know the future, unfortunately. But what, generally will happen over time is that those, quality investments generally will go up over time, which is really interesting. And being in the market, especially in the share market, is where you're continuously buying in. That's a whole different scenario, how you control the market risk. With property, it's a little bit different, but just getting an understanding before you go into anything, understanding your time horizon, your risk profile, how you're going to handle. Most people only talk about the upside, how this is going to make me so much money, and controlling how, when the market goes down, how you're going to react, but also what safety mechanisms have you put in place. So one of the big things can hurt investments and so forth is breakdown in marriages or partnerships or whatever, however you bought those investments, or you could get ill, something could happen, you bought into something, went down and something happened. So it's with insurances and so forth, protecting your family, but also protecting your investments so, they can continue if something happens to you, I think is really important. The marriage breakdown thing is very difficult to protect against. There's one of the things that
But something that's not, like you read about now, that's not uncommon anymore, it's getting more common, is like young people buying properties, not necessarily in a relationship, but buying properties together, going to like a business transaction to buy a property. And that's a real thing as well, because now you got to understand when you go into that is what's the one person may meet someone and it makes it quite difficult. So you really got into that with eyes open and understanding what may or may not.
Good contracts. Getting lawyers involved, and that actually has been coming up a little bit lately, where there is a lot of pitfalls in what could happen, and someone needs to move out of that investment. So whatever the long-term thing is, but things change. Life is fluid; it moves. Our situations change, and all that sort of stuff. So just put some more tactical scenarios that we could take into places. One is timing of when we are looking to get out investments. What can we look at there?
Obviously, if there's big capital gains, one is trying to time that. If you're a high income earner and you're getting close to retirement, so trying to time the sale of that investment so that it falls in a year where you have lower income. Obviously, we touched on when you're setting up that investment, trying to direct the income or cadence to someone on a lower tax bracket. One the other day was someone wanting to sell shares, and they had all these gains. Some of these shares were big gains because they wanted access to the money, and then they had these shares with these big losses, and I'll just hang on to them because they may come back. I was like, if you've got this big gain, why wouldn't you just... So if you've got losses, look to use those up if you can to try and minimise the tax you're gonna pay.
Yeah, I think also one of the big ones as well is how long you're holding the investment for. It's one of the things we probably haven't touched on. I was actually reading something on the weekend where it said property, everyone thinks it doubles every 10 years, or there's a lot of comment around that. It's actually around 17 or 18 years potentially, and that's not all property. It's generalised. Some could do it sooner, some could be long, but also there's a lot of holding costs and so forth generally that need to be taken into account, especially in these days. So not everything works that thing. And same with the share market. We generally don't want anyone going in less than 3 to 5 years in that scenario. If you're going into property, it's depending on your overall strategy. You just got to really take into account what is it for, and then it comes down to if you're going to work the next 10, 15, 20 years, depending on what your time horizon is, do you need more income now or do you need more capital growth? So what is the actual purpose of the investment? Because there'll be ones that do better than others, and depending if you're going into the share market, it's pretty low entry, but obviously there's a million different things to buy into, and then you've got a different leverage around that, whether it's leveraged investments, borrowing money, all that sort of stuff. And then you've got investment property where generally that's going to entail people borrowing money to do something which has a lot of high costs initially, and if you went to sell it tomorrow, generally it's not going to be in a good position. So it's like a longer term strategy that most people need to prepare for. So I think in there, getting an understanding of what you're actually trying to do, achieve, depending on where you are, if you're in your 30s, 40s, 50s, or 60s, even 70s, who knows? There's different scenarios. And I think holding investments for a different period of time, there's different things that work, and there's definitely things that don't work as well. So I think identifying your goals, what you're trying to do, where you're trying to get to, most people overlook that rather than what's going to make me the most money. When that's actually really a difficult thing to answer, depending on what's going on. Have you got any final thoughts about this topic?
I think it's all about planning and preparing. I think everything we touched on was about make sure you're planning, because like with some investments, if you go like into property, there's high entry costs. It's not quick to get out. It's cost to get out. So it's understanding, I suppose with any investment, there's an element of risk. So it's understanding what your comfort zone is before going into an investment, planning around that. So I think you mentioned like growth and income, like what's the purpose of the investment? What's the time horizon for the investment? Is it income? Is it you growing? And you're just planning around it so that you're not, because you don't want to get in a situation where you have to sell or something happens and you can't, there's a change in your situation. It's going to either you can't easily change what you've created, or it's going to cost you a lot of money, whether it be tax or fees or whatever it is.
Yeah, I think there's never been probably a lower entry to a lot of different investments these days, and people can get overconfident in different scenarios. I think that can be definitely a trap, and especially for people who want an investment to do more than they possibly can for them. That's where I've always talked about. There's a lot of people who buy Tats Lotto tickets. Actually, I don't think I've ever bought one in my life. I thought I'll use that money to make some money. So everyone getting understanding risk profiles and what type of investments, and it can be a really tricky area for a lot of people. So really balancing out that and understanding that every investment does have risks over time. But if you use your money very wisely and go into sound investments over a period of time, I think you can make a massive difference to yourself. And that's what I've found for myself, but also for all the clients that we do have. 10-year period's a short period of time. 15 years, a lot of things can happen in that period. And all the probably wealthiest people you see out there, they generally made it when they're older. I think Warren Buffett made I can't remember how many his first billion took to his probably 60s or whatever. And then from then on, he made so many more. But that's a common thing. A lot of people we deal with, their money has come later in life after those investments. They were lucky enough to make those investments 10, 15, 20 years ago. Getting out of the mentality of the get rich quick scenario for a lot of people. But over a 10-year or 15-year period, I think people can do an amazing job of it.
Definitely.
Thanks for watching. If anyone needs any help in that scenario, I would like to talk further about anything we've spoke about today, please feel to reach out, and I look forward to chatting on the next episode.
Thanks, Dave.